about a completely different part of the world. So Matthias is going to talk to us about Barings Emerging EMEA Opportunities, which invests. Well, I'll let him explain exactly what it does. When I hand over to you, Matthias, for a minute, you explain what the fund does, please. You're just on mute there.
Okay.
Yeah, very good.
So here we go. Thank you very much for an invitation, and I'd like to take this opportunity and talk about exactly that. Right. So this is Barings Emerging EMEA Opportunities, and as the name says, we are investing. I'm investing in EMEA markets, and especially, and to be more concise, in equities, public listed equities, in countries like Saudi Arabia, South Africa, but also the new EU member states. To sum it up, it would be currently the portfolio is a third Saudi Arabia, it's a quarter South Africa and Africa. It's 20% the more consumer-orientated parts of the Gulf states, mainly the UAE. And then the remaining 15% would be the emerging European countries and new EU member states such as Poland, and predominantly Poland, but also Greece. And it goes across all sectors. So to sum it up, it would be, at the moment, preeminently Gulf states investments plus South Africa and wider African investments. And a sliver of emerging European investments. The idea, of course, is to make use of rotation here and to rotate this exposure as we deem fit following our investment process, and that's a process that's focused on growth at a reasonable price. So that's in a nutshell what we're doing.
Okay, thank you. And you've got about 80 million of assets. What sort of, presumably you'd like that to be bigger, but what sort of assets under management have you got running in that strategy within Barings?
That would be about 2 billion in the strategy. So this is a small part, but not an overlooked part, I would say. It does benefit tremendously from the fact that not only we have 2 billion of clients' money in the strategy, but we, therefore, and closely related to that, we can also afford to run a team. I cooperate with a team of 5 other people who focus entirely on the region and entirely on EMEA equities, and we collaborate also in a wider sense of things with our colleagues on the debt side who are investing in EMEA debt markets. So I think there's a strong infrastructure that backs the investment process up. It, of course, the onus is on me to deliver returns on the back of that, and I'm very confident we are able to do so. I'd also highlight that as a side product, we're also focusing on yield. As a side product, even though we're not focusing directly on that, we generate yield. That has to do with the fact that has mostly to do with valuation, as valuations have come off in certain parts of EMEA. The yield generation angle actually emerges, and that's something that we find acts as a good indicator for the ultimate and underlying valuation of our region. I personally believe that this is a growing yield. So why can I say that? That's clearly I highlighted to you that our process is based on growth at a reasonable price. So we're not looking into self-liquidating companies. We are indeed focusing on growth, but at the same time we can generate this yield, which is, as I pointed out, not our main focus, but in essence related to the attractive valuations that we see in certain parts of EMEA equities. What you see in front of you is a map. Clearly, the biggest landmass here is Russia, and I will talk about that right now. And just to make sure that we communicate that correctly, we do have Russian exposure in our portfolio. We marked it to 0, but we hold the underlying equities. We were hit We were hit tremendously by what happened in Russia and the actions that President Putin took by declaring war on Ukraine. But we don't fuss around with it. We marked it down to zero. We are observant of all sanctions, and we condemn the war. Therefore, you might say there's an implicit option embedded in every single share. So should our underlying portfolio of Russian equities become ever tradable again, this would have approximately a substantial uplift, of course. At pixel time, at the point of invasion, approximately 1/4 to 30% of our portfolio were invested in Russian equities, and that's marked to zero currently. I do, however, believe that even taking that into consideration, our long-term work has not been for nothing. We have steered the portfolio away from Russia in due time. Russia used to be up to 60% of our portfolio, and we have reduced it over time by changing the strategy into the wider area of EMEA and away from emerging Europe only. Therefore, our 5 to 7 year performance, even taking into consideration marking down our entire Russian portfolio to zero, looks quite okay. And as I pointed out to you at the beginning, I do believe that the wider region offers a lot of opportunities as we speak. And I hope I can make the case in the next 10 minutes or so why emerging EMEA opportunities and why EMEA equities per se should have a place in your portfolio.
Thank you. I mean, 25-30% of portfolios was their value at nil now. I suppose that's kind of like option value really for the future.
Yes, that's it. It's clearly it's option value. You pointed out. We do not see that reflected, or we believe we can't find this option value reflected in the NAV. Sorry, not in the NAV. In the NAV, it's of course zero, but we don't see the market giving any value to it. So I would say at the moment it's a free option. Who would turn that down, right? It does still mean we're doing work, right? So I personally follow Russia very closely, so I'm very interested in what goes on there. But on another level, we're also keeping up our work, as we would call it, light coverage with Russian companies. So we're still researching Russian companies. Public records are available. Quarterly earnings are being released. There's this notion of normality in Russia, which took, of course, a hit over the last weekend. But there's this notion of normality in Russia, and therefore we also keep up our work with regards to coverage in Russian equities. But as you point out correctly, it's an option. I do not see the market giving any value to this option at the current time.
And if we look at the rest of the market of the EMEA area, does that correlate well with other emerging markets, or does it tend to perform?
Yeah, it's a very low correlation, which I think, I'd love, low correlation is often, marketed as a good attribute per se. Yes, it's lowly correlated to most other markets in the world. However, I want to point out that it doesn't mean that I can relax and lay back. So it's low correlation only pays off if it's attributed to positive absolute performance. But I hope I already got across that I believe there's a very strong case for positive absolute performance. You probably want to ask in which currency, but it's clear that especially our Gulf exposure has benefited tremendously from the fact that those countries are pegged to the US dollars, and they're not. And the peg itself doesn't mean anything, of course, but we think that this peg is very well underwritten. So this is certainly something that we deem as a positive, and therefore you won't be surprised, to hear or have heard from me that if we combine our largest market, Saudi Arabia, with the more consumer-orientated parts of the Gulf states, that's approximately 55% of our portfolio at the current stage. Yes, these are the four main topics that we want to get across to the audience today. I talked about the experienced management team I have the honor to work with already, so I'm not going to touch on that, but it's certainly a strategy that's of enormous importance to Barings, and we are investing into talent and retention. But the undiscovered growth, I think, is something that will come to the fore this year, and is coming to the fore this year. I think the Gulf region is really one of the few kind of isolated regions in the world right now. I think this sets to continue, and I think, contrary to the past, as we believe that the political and economic actors in the Gulf take wiser decisions with regards to reinvesting the riches that they are earning. And therefore, we are maybe, I would say, mildly positive that the growth tangent, which doesn't seem to be incorporated into equity prices at this stage, is going to continue into the future. And this feature will be, I think, a very rare feature to find across the globe, especially in the next 2 years. The income diversifier is something that I highlighted to you. It's we bring it up here because we think it's an attractive feature, especially for income, of course, for income-oriented shareholders. But it's also I would say a disciplinary action for myself. Right? I will have to keep in mind that returns are being generated and returned to shareholders, and I think it's a very good balancing act, especially when you claim to be growth at a reasonable price. The reasonable price element actually should translate into some sort of revenue generation, and it indeed does. And therefore, we aim to generate 3 to 5% dividend yield at the current share price going forward. The important point is, and I want to be really measured on that item, is that we make a strong case that this is a growing dividend. And as we are not investing, as I pointed out, into self-liquidating companies, but we do invest in growth, and therefore, of course, the underlying notion is that as the EPS growth, we are actually also stand to benefit from the relevant growth in the DPS. The high conviction strategy is one where we want to keep the portfolio at about 40 to 45 names. It's something that is also translated across many strategies at Barings, so this is not specific for BEAM or for Barings Emerging EMEA Opportunities, but at the wider group that I'm then working with. So it's in our DNA, and we also apply it for this particular company. I'm personally and professionally a big fan of conviction, and I'm very confident that the underlying structure of the market allows us to pick winners. In other words, we do believe, and we do see currently, that I think the heated environment on the global stock markets does allow for a greater degree of mispricing, and we are very keen to take advantage of that.
There's a question here actually that we could answer now. So how big is the universe? How many stocks are you looking at?
So I exclude the entire Russian universe, of course, even though we are still doing light coverage on Russian universe, but it is approximately 130 to 150 stocks. Okay.
So is that because of this liquidity screen that you have to apply to things?
It's just not. No, I wouldn't say so. It's just of course, I do exclude microcaps. Right? If you exclude microcaps, you would go into 300-400. But I do exclude companies that are smaller than $200 million.
Okay.
It is actually not such a small number of stocks. I think importantly here is that you have also a substantial degree of diversification. That's certainly the case. So we find stocks across all sectors imaginable, I would say. So I wouldn't agree with you that this is mainly to liquidity. We do look into also rather illiquid stocks. The reason for that is that I want to make sure that we stay nimble and that we can leverage the advantage, the advantage that a smaller size brings you. So therefore, I'm making a strong case within Barings that even though we run a portfolio that excludes certain stocks from the mainstream accounts, that the adequate work is being done for BMO. A good example right now is that I lead a project to evaluate 3 middle tier Polish stocks with a market cap of 200 to 250 million USD. That's certainly not going to be mainstream, but in terms of the wider Barings. But I believe that those stocks have the potential to double over 3 to 5 years, and therefore we make a concerted effort to look into that. We would also communicate that to other teams at Barings, surely. That would, for example, the Barings European Opportunities Fund. That would be one group where we would lead a discussion about that and hope to learn even more than our point of view, but to incorporate also the view from European small and mid-cap investors to come to a final conclusion.
Okay. There's the two of you, portfolio managers. So altogether, 28 people working on the fund.
Yes, yes. So I wouldn't say that it's so. Adnan and I are the main decision makers, and we have been working together for quite a long time. So it's 10 years plus, where we share the same desk. So it is us who are taking the decisions on the portfolio level. We directly collaborate with a team of EMEA analysts and investors that is made up out of 6 people. So I work with 5 other people directly, then more indirectly with our colleagues from other funds, such as the European Small and Mid-Cap Fund, as I mentioned, but importantly and especially on the macro side, the fixed income teams, EMEA fixed income teams. And then, of course, in the wider sense, with global emerging market investors. So I think that's what stands behind the 28 individuals. But directly at the fund level and with regards to BMO as a company, it is 6 people who collaborate, which I think is a very decent team, and certainly doesn't give us any excuse, right? If you cannot shift the workload and cannot come up with adequate ideas, then you have such a strong commitment from your employer, you're getting something wrong.
Good. Okay. We'll come back to ESG later on, but let's have a look at where the portfolio is now first. So this is the picture at the end of July. So do you want to talk us through some of the sort of weights here and the thinking behind them, please?
Yeah, absolutely. You see, I think it's time to spend cash. You see that I'm reducing the overall cash level, and you see that I start to rotate from the very strong performing Middle Eastern markets, and I start to pick up really punished and underperforming European markets. I think that's in a nutshell what you can see here. So you do see that the exposure in Hungary and Poland is gradually increasing. This is being essentially funded by Kuwait, which is from our perspective the most boring and overpriced market that we operate in. With where we see very limited, positive, where we see very limited stock picks on the one side, and an overall limited performance potential. So yeah, I think it's an aggressive rotation that you see that is taking shape here, and that's one of the characteristics of these markets, that the underlying valuations have been starker than they ever have been. I think this contributes to the overall low correlation of the company to global markets, which I pointed out as a good feature, as long as we are capable to turn that into positive absolute performance, which I'm very hopeful that we can. Therefore, not touching on any single stock developments, But as a general development, you do see that we're shifting exposure to underperforming parts of the portfolio.
Is there a sort of limit on how far you deviate from the underlying index?
There's no limit, so there's no index level per se, but we do focus on ex-ante tracking error, which has been quite a good measure over the years. So when we compare ex-ante tracking error by our factor models with the historically realized standard error of residuals, aka the tracking error, the forecast models have been relatively solid, and we trust them. So it is the ex-ante tracking error which we want to keep between 3 and 6%. The logic behind that is that we believe that the overall long-term performance of the market of the underlying index will be positive, and we want to generate an additional return of about 1.5 to 3%, which translates into an information ratio of 50%, which we hope to achieve and have achieved in the past. So this is essentially the logic behind that. So focus not necessarily, don't get tied up in trying to understand whether or not you should be underweight or overweight a specific sector or index, and get lost in absolute and relative exposure, but focus entirely on stock picks. Do take note of what this translates into with regards to the underlying tracking error, which is which we see as a risk budget. Mm-hmm. This is the fuel, this is the battery power we need to put in our portfolios to outperform. Therefore, we only want to use as much fuel as possible, clearly, as we have to pay for it. And we think that a tracking error of 3 to 6% will lead to satisfying returns for our shareholders in the medium to long term. And by that I mean an absolute positive performance of the share price, plus on top of it a decent dividend yield, which we hope would ultimately translate into high single-digit to low double-digit total return.
Okay, thank you. The big financials rating here, is that mostly banks?
It is mostly banks indeed. We with a few with the odd insurance company involved too, but it is indeed mostly banks. And here, we were in July. We were of the opinion that the yield curve would react stronger, right, as we see currently, and therefore, I personally believe that this strong exposure to banks, given the underlying valuation and what we expected would be a further shift in the yield curve, makes absolutely sense.
Okay, let's look at the.
No, go ahead. Sorry, I did interrupt you.
Sorry, I was going to say the next item here is performance, but I think we've got. Do we get the top 10 holdings or no? I imagine.
No, but I can talk you through that if you want.
Yeah. What are the largest holdings at the moment?
It's probably even more entertaining than when you see it on the screen. So the top holdings would be, so not surprisingly, to be found in Saudi Arabia, if you allow me to start there, and in the UAE. In Saudi Arabia, it would be the largest bank, the two largest banks, which is Al Rajhi and SNB. In UAE, it would be the real estate developer. And on the top of it, we have the dividend-generating telco companies in South Africa and in Saudi Arabia, plus an insurance company in Poland by the name of PZU, the largest insurance company in Poland. So these are the largest holding. That would be 8 out of the 10 largest holdings. And I repeat that again, it's the two largest Saudi banks, SNB and Al Rajhi. It would be STC and Etihad, the domestic and more international focused telco operator in Saudi, respectively. It would be the Emaar and Aldar, the leading real estate developer in the UAE, where we, and I'll talk about that in a second, plus MTN, the largest Pan-African mobile operator, and PZU from Poland as number 8, which is the largest insurance company in the new EU member states, plus MOL from Hungary, and leading integrated European energy name.
Okay, that's helpful, I think. Big picture again. So obviously the Gulf states have been doing particularly well recently because of the higher oil price. Do you see that there's a threat to those economies in a kind of net zero world?
The answer is no, because I see that the underlying cash flows are being really channeled into projects that do make sense. Not every single project per se makes sense. So I think there's a bit of hybrid, as you would expect. Maybe the audience, I'm sure that a lot of the audience have heard about NEOM, this kind of futuristic metropolis that is going to be built in Saudi, right? There are all kinds of vanity projects around that, but as a matter of fact, for the bulk of the generated cash flows, and that would be my answer, the bulk of the generated cash flows in the petro economies of the Gulf states are being channeled into energy transition. Interestingly enough, right? It is. And I think that makes it so interesting, right? And I think that's certainly an element that hasn't been around before that. So there's a positive attitude to energy transition, as far as I can tell, and as far as I can judge by the relationship that we have with various companies, be they in our portfolio or not, with regards to reinvesting cash flows into energy transition, into the hydrogen economy, into electrification, into infrastructure. All of that makes me very positive, especially since it's not only what is beneath the ground, right, with regards to Saudi Arabia, that makes this country quite interesting, i.e. the hydrocarbon riches. I think it's also the sheer land mass and exposure to sun, right, which if you ask me, make it one of the strongest candidates to benefit tremendously from solar, right? Especially when you judge other geographies that are near Europe, that are similar geographies near Europe, which cannot actually guarantee similar security, right? As a matter of fact, right? When you look into North Africa or indeed Central Asia, you wouldn't find any other country that has similar prerequisites with regards to the solar, with regards to the revolution in solar generated electricity. So all of that makes me rather positive, to be honest.
There's a question here about the impact on consumers of, I guess I'm really talking about inflation and we're obviously seeing our income squeezed here. Is that a problem for people in the markets you follow?
It is a problem. It is certainly a problem, especially for emerging Europe, right, and the new member states. But I'd highlight two things. First of all, I think maybe you're surprised to hear that we have direct exposure to real estate, and it's a substantial part of our portfolio, as you can see. I mean, it's 5%, but I think it's a substantial part of our overweight. It is essentially two companies that I highlighted before. They're both located in the UAE. And I think even though real estate is the worst performing sector in Europe currently, which is in itself, of course, interesting. But we do see that our exposure in real estate actually performs the opposite way. It performs extremely positively. And I think that is part of the answer. Right? It is the affordability of real estate is actually looking good. We see that demand is increasing, so this has also to do clearly with a lot of Russians trying to leave their country and finding a plan B, and Dubai is benefiting from that tremendously. Also, the overall cap rates. I mean, let's say the starting point of the discussion that leads to an ultimate valuation, right? Is the kind of intrinsic yields that real estates have, be they commercial infrastructure or residential in Dubai. Is much higher. So we like all of that, right? We like the fact that affordability remains high. We like the fact that inflation is not that tremendous, and therefore that real household income growth remains positive. And we like the fact that the starting point is just much more realistic, as the so-called cap rates, i.e. the intrinsic yield that is being deemed fair or adequate, is simply much higher, and therefore valuation much lower, actually, compared to other places in the world. All of that makes us rather positive. So I think that's a good, that's the first part of my answer to your question. And with regards to, yeah, we do see a tremendous squeeze in income across the board. I would say that certain parts of Africa, probably have learned to live with that for much longer than we have. So kind of this underlying inflation and real income question or challenge that comes up is a fact of life for large parts of Africa for much longer than in Europe. So I'm rather confident that those societies can handle that in a better way. I know that this is, and I don't want to come across in a cynic fashion, but I really admire the ability of a lot of economic actors and families and households to make ends meet, and they have done that tremendously, even in very adverse political environments. So I guess there's an element of that in there too, when it comes especially to African investments that we make. And then we mainly invest into income insensitive, i.e. low elasticity products, such as mobile telephony. We think that even in an environment where household budgets continue to be squeezed, that the element of data usage and mobile phone, as actually contributing positive to quality of life, and therefore will remain well bid and subject to low income elasticity. And in Europe, yeah, we'll see. I think the reflection, and in Europe we'll see, right? I think the stock markets reflect the upcoming recession very well. Poland, for example, is a country that had a real income growth for the last positive real income growth for the last 12 years. In the last 12 years, Polish wages doubled in real terms. So that is turning around aggressively right now. But we do think that the stock market is adequately reflecting that. And more importantly, we are positive when it comes to debt levels, right? Where emerging European economies are simply far less indebted on the corporate, on the household, but also on the sovereign level. And that gives them a lot of wiggle room. If you allow me, if you maybe look at the chart with regards to underlying interest rates, there's one point that makes me very positive right now. Here we go. So have a look quickly on the right-hand side panel. So these are emerging European new EU member state interest rates. So you do see that Hungary has caught up with South Africa by now on the long-term interest rates. I would also say that I personally believe that we have seen the highs in most countries. So if you look at Romania, Poland, or the Czech Republic, I think we are very close, or we have seen peaks already. So in a sense, this is something that those countries have. I think it's an advantage relative to the UK or Eurozone countries, that the resetting of underlying interest rates has been much faster and much more aggressively. And I think it has brought interest rates to an adequate level, right? If you look at Hungary, I think that 10% yield on the 5-year is not nothing, right? And it has, of course, repercussions on economic activity. But we are there yet. We are already there, right? It's not kind of held back by kind of political efforts. It's a price clears the market phenomenon that we do see, and that makes me positive that the worst is behind us with regards to cost of capital in those countries. One of that, I think, it's a benefit of being sovereign on the monetary side of things.
Okay, that's really helpful, I think. And this other chart, the on the PE ratios here, I think is interesting too. Actually, you better explain what the different indices are, because people might not understand.
Yeah. So, like, if you go, let me go through the things very instrumental to So the left-hand panel highlights various PE ratios, and if you start from top to bottom, you see top would be the Saudi market that, not surprisingly, undergoes some mild re-rating. Then the next line would be the MSCI Emerging Market Index, so that's the average MSCI Global Emerging Market Index. Then it would be South Africa. The orange line would be highlighting South Africa. Then Poland in blue, which sees a tremendous de-rating, as you can see. And last in green would be Turkey. Right, so these are the markets that are representative of the region we invest money in, and hardly ever have I seen a picture that has been starker than the one that you see in front of you. Right, it is this fanning out of underlying valuations. I know that PE is a very limited way of describing valuation, but it's a very simple one and very straightforward one. So I took that. And hardly ever have I seen a starker and more diverse picture that allows me to rotate, right? And that allows us to rotate. Rotation itself is not a means to an end, right? We want to make money out of it, and we want to focus on stock picks, not top down. But it's clear to see that for example, in countries such as Poland, some interesting opportunities do emerge. I would even go so far as to say that in Turkey, also interesting opportunities emerge, companies that are extremely well run and will survive the financial Armageddon that is ultimately coming on this country, on this particular country. All of which does, however, not mean that I can't find investment opportunities in Saudi. It's not the case, or as I pointed out, in real estate in the United Arab Emirates. That's not the case, but it allows us to rotate part of the portfolio and benefit from the wide diversification that we see in the region. I do believe that the region overall will add some steel to anyone's portfolio, if you allow me. And I think this kind of resilience and resistance is something that will pay off over the next quarters, and hopefully also enable us to generate a decent return that will be distributed in the form of dividends, plus an appreciation of our share price.
This chart here, this is Saudi Arabia, which obviously, as you say, so the market's getting more expensive, but you're encouraged by the projects that they're investing in. Absolutely,
you're right. Yeah, and this is only the fiscal side of things, right? This does not take into consideration the cash levels that are building up on the company level, right? But you do see that the fiscal picture is extremely positive in Saudi, and you're right, the country itself, but also the relevant companies, which are not incorporated in this in the fiscal balance, of course, do reinvest, we believe, more wisely than they have done in the past, and see the energy, and importantly, do see the energy transition as an opportunity for the country and not as an existential threat.
And so, do they need oil prices to stay? What's the sort of break-even rate for that?
Yeah, the break-even rate, as you can see here, the break-even rate in 2022 is below $75, right? So which makes per barrel of oil. So clearly, it's a young economy. Demographics are positive, so this is going to increase. So the fiscal burden is going to increase. However, at the same time, we see the introduction of taxation. We see that overall the pampered and privileged lifestyle of certain parts of the Saudi economy, of the Saudi population, is coming to an end. So it's clearly large parts or certain elements of the Saudi economy are kind of having a rendezvous with reality. And I think that's exactly the right policy to incorporate. So yes, this fiscal, let me say, break-even point currently stands at around $70, and it will creep up. But we believe that, first of all, Saudi has the means to keep the oil price at around this level, as it's a swing producer. And if anything, I'm worried that the oil prices go higher than lower, to be honest.
Yeah, fair enough. unfortunately, we could go on for ages, but let's have a look at the performance here. So just make it clear. So all of these numbers are skewed by what's happened in Russia, presumably.
Yes, you can see that this year, is a particular tough one with regards to Russia, and I'm also, admittedly, not admittedly, as a matter of fact, we were overweight Russia relative to the benchmark. So that has hit us. We accept it for what it is, and we stay focused in doing our work and generating total return growth for our shareholders, and hopefully also a solid dividend underpin. We, as I highlighted before, we were concerned about the undue weighting in Russia, and we were positive about the overall opportunities in the wider region, and we wanted to leverage the research capability that Barings has built up over the years, also for this particular company, and that's why we have widened the underlying investment universe 2.5 years ago, which was of course a very good decision with retrospect, and therefore I think that therefore we will be able to mitigate the shock with regards to that has happened this year over the medium to long term. And of course, there's always the hope that the situation improves in Russia at one day, and I wanted to highlight that this would then translate that this intrinsic option would be valuable again.
Good, thank you very much, Matthias. I think that's honestly it's really interesting. There's so much going on here and so many different markets to talk about, but we are running out of time. So I think we should probably wrap it up. I mean, I will point out that this fund.
If you allow me to wrap it up in one sentence, I think that I think if in one sentence, I think that EMEA equities do make sense from a portfolio perspective, as they add resilience to a portfolio in times when resilience is something that is extremely attractive, if you ask me. So that's it in one sentence.
Yeah, I think that sums up quite well. I mean, I was going to point out that basically the fund is trading at a discount, in contrast to the JP Morgan Russian fund, which is trading on big premium. So yes, I don't think that kind of hope value with the options is really reflected in your
absolutely. So in other words, this option is completely not priced from my perspective, but that's all speculation in the end, right? And I don't want to revert to that. Russia is not, Russia per se is not a reason why you would invest in BMO.
Yeah, exactly. Great. Thank you very much indeed. Okay.
Okay. Thank you for the time. Bye-bye.
We will be back next week talking to the manager of Schroder Japan Growth, and we're also going to have Andrew Mahati here to wrap up what's been going on over September. And so it's going to be an eventful month. We'll see what the coming week has to hold for us. But in the meantime, have a good week, and we will see you next time. Thank you very much.